Hey guys, it's Matt Hogan with Element Real Estate. And today we're going to be talking about the recession, the real estate market. Is it going to get crushed like it did in 2008? Well, I've got the answers for you, sort of. Stay tuned. Okay, so we're diving into the recession. First thing I want to say is my eyes, I have not been hanging out with the Grateful Dead. It's been a long day and I spent a couple hours in the ocean, so give me a break. Cut me some slack. Okay, on to the recession. There's talk about there all over the place. Social media, mainstream media about recession, housing market, 2008 recession, and I figured it'd be a good idea to pull some slides together and answer some questions and display some facts. So I'm going to jump right into it. First thing, let's define what a recession is. I took the most generic definition out there from Forbes, March of 2019. They say the rule of thumb definition of a recession is 2 consecutive quarters of negative gross domestic product GDP growth. Essentially what that means is a sustained period of time where the economy doesn't grow. So now that we know what the definition of a recession is, let's dive into what are the odds. So the odds of a recession coming are 100%. For sure, without a doubt. There is no chance it won't come. It's kind of like a meteor. A devastating meteor, the chances of that hitting the Earth is 100% over a long enough period of time. It is coming. The only question is when and how big is it going to be? Same thing with the recession. There is general consensus on the answer to those questions, which I'm going to dive into right now. So this is a graph that shows a survey of sorts. The Pulsonomics survey of financial analysts, Duke survey of CFOs, National Association of Business Economic Members, all sort of are descending on 2020 as the most likely date the recession will start. There's some differentiation here, but in general, 2020 is the consensus. So we know what a recession is. We know when it's coming-ish. Let's find out what it means for home prices. So a similar list of experts were surveyed on what they think home prices will do in the next 3 to 4 years. And you can see every single resource for every single year is projecting home prices to increase. Let me say that again. They're projecting home prices to increase between 2019 and 2022, even though we will be in a recession for some period of that time. That's important because during the last recession, 2008, we had a massive drop in real estate prices. And if you look at what the consumers are saying about the upcoming recession, their opinion is widely different from the experts who know a thing or two about the economy. This is from a survey that was from Realtor.com just last month in August. Will the U.S. housing market fare better or worse than the 2008 economic recession? 57% think it will be as bad or worse than it was in 2008. Do you guys remember 2008? It was absolute carnage on a global scale. Housing prices dropped 20% nationally, but some markets were down 40, 50, 60%. And so for the average consumer to think that it will be as bad or worse than that, when every single or most of the expert resources out there believe that house prices will grow marginally in the next 3 years, that's a huge disconnect. And we need to dive into why there is this disconnect. And essentially, what's happening is something called the halo effect. Consumers were stung bad in 2008, and that's what they remember. They remember the most recent recession and their experience in that recession, which for most people was very bad. So you can see here in 2008, yeah, bad recession, but that was a recession that was triggered by a mortgage and housing crisis. That was one of the, if not the main cause of that recession. In general, when you look to past recessions, you see that home prices, if you go back to 1980, they didn't drop. In fact, in most cases, home prices increased. These are marginal increases, mind you, 6%, 3.5% over 2-year time frames, a 1.9% drop. Marginal increases, but increases nonetheless. Why do home prices generally increase or still increase when we're in a period of where the economy is shrinking? Well, when the stock market is way down, which happens sometimes in a recession, a lot of those investors will pull money out of the stock market and they'll put it into another type of investment that's diversified. And in many cases, that's real estate. So that investment into the real estate market props prices up when the rest of the economy is shrinking. So really, really important to note and to not get amnesia here and to look at like historical data in the past 40 years. Almost every recession, again, home prices have increased. The experts are predicting home prices to increase. And the reason I'm emphasizing this is the only thing that could really hurt us in the upcoming recession as it relates to the housing market is fear. There's nothing to fear but fear itself. Well, that is really, really true. And if home sellers get sketchy and panic sell, well, that will drop prices. But the recession in itself inherently is not likely to drop prices on houses. So the net here, what's the net? The net is if you're a seller, stay cool, no panic selling. Prices are, again, supposed to increase in the next 3 or 4 years. And if you're a buyer and you want to time the market, you think it's going to drop 10 or 15% during the recession in the next year and a half, not a good idea. If you find the house you like, go for it, buy it. Trying to hold out and get the deal of the century, it's not likely going to happen. So that's it. That's recession. That's housing prices. Thanks for tuning in, and we'll see you next time. Adios.